Do you want your money to grow this year? Picture this, a time-tested technique that's transformed small investments into substantial gains. Surprisingly, a mere $1,000 can pave the way for remarkable growth. The key? Identifying the optimal investment avenues and letting your money work smartly. Watch this video till the end because I'll unveil Warren Buffett's 5 essential strategies to supercharge your $1,000 in 2023.
Through the next 10 years, actually returns averaged about 50% a year, and I think they were 37 points better than the Dow.
All right, let's break down the nitty-gritty truth about tossing that $1,000 into the stock market. You know, that place where the financial roller coaster never stops. Now, before you start picturing yourself sipping cocktails on a yacht, let's get real. The stock market's average returns dance around 7% per year, which ain't too shabby, right? But here's the catch. If you park your grand in there, after 5 years, you'd only be wavering at around $1,400. Yep, not exactly a skyrocket to the realm of the rich and famous. It's like your money is chilling on a slow-moving train, taking its sweet time to get to the destination. Now, I'm not saying the stock market's a total snooze fest. It has its moments of excitement and drama that put reality TV to shame. But turning $1,000 into a whopping $10,000 in a year? Well, unless you've got a fairy godmother with a magic portfolio, that's quite the tall order. So, while the stock market's a cool spot to park some cash, it's not the autobahn to instant wealth. Now that we've taken our ride through the stock market reality check, let's steer our financial journey to a place that's often considered the land of yawns and eye rolls. Yup, I'm talking about savings accounts. You know, those places where your money curls up for a long nap. Remember, we just got off the train where our $1,000 grew to a modest $1,400 after 5 years. Well, in a savings account, the story's a bit different. Picture this, your cherished $1,000 tucked into a savings account with an almost microscopic 0.33% interest rate. Think of it as a financial slow-mo, not the dynamic leap you'd hoped for. After 5 years of patient waiting, that $1,000 would bloom to a grand total of $1,106. Savings accounts offer security, yet lack the vigor for your money to soar. But fear not, we're just revving up to magnify that modest $1,000 into a dazzling 10 grand. Let's recap. We started with a reality check at the stock market, acknowledging the gradual tempo of wealth building. Then we rode the snooze-inducing savings train, where even ninja snails would move faster than interest rates. But now it's time to gear up for a strategy as exhilarating as a fireworks display. So remember that trusty $1,000 we've been toting around? Instead of sending it on another round of financial merry-go-rounds, how about using it to invest in yourself? Yeah, you heard me right. This is where things get seriously juicy. Imagine taking that money and putting it into education, training, or skill building. Whether it's coding, graphic design, or even learning the art of crafting a killer cup of coffee, investing in yourself is like pouring rocket fuel into your own potential. Here's the deal. When you increase your value and skills, you're not just growing yourself, but also your earnings potential. That $1,000 could morph into a lifetime of higher salaries, freelance gigs, or even a full-blown career switch. So buckle up, because the road to turning $1,000 into $10,000 just took a turbocharged turn.
Most people go through life using up a very, very small part of their potential. And so anything you do
Now, let's dive into a strategy that's not only exciting, but has the potential to turn your financial world upside down. In the best way possible, of course. So, that trusty $1,000. Instead of just letting it chill, what if you used it to kickstart a side business? Oh yeah, we're talking about tapping into your inner entrepreneur. Whether you've dreamt of baking custom cakes, creating handcrafted jewelry, or even starting an online store, this is where the magic happens. You invest your $1,000 to get the gears turning. Maybe you buy supplies, set up a website, or even run some ads. As your business starts picking up speed, you reinvest those profits back into the venture, creating a cycle of growth that's like watching your own money tree flourish. Plus, here's the beauty of it. This strategy has the potential to generate passive income. So as your business starts humming along, the beauty of it is that you're not just relying on your day job for income. Now that you've created a side business and started generating income, it might be opportune to consider expanding its growth potential. What if I told you there was a way to diversify your investments and reduce risk, while steadily growing your money over time. Say hello to index funds, your ticket to building wealth through smart, diversified investing. Index funds allow you to invest in a basket of stocks or bonds, reducing the risk of picking individual companies. They provide built-in diversification and long-term growth potential. Index funds are an accessible path to growing your $1,000 into something far greater down the road. Rather than gambling on hot stocks, use index funds to build a foundation for your financial future. They're a group of stocks or bonds that represent a specific market index, like the S&P 500. Unlike banking on a single market star, these funds diversify risk across various companies. QVOO, SPY, or QQQ. They're the heroes tracking top firms, offering steady growth and lower fees compared to mutual funds.
Presidents, 7 Republicans, 7 Democrats. We've had world wars. We had 9/11. We had the Cuban Missile Crisis. We have all kinds of things.
Best part? No stock genius needed. ETFs imitate the market's upward trajectory. While you manage life, your money's out there multiplying effortlessly. So while you're juggling life, work, and, well, everything else, your money's out there doing its thing and growing. And the best part? The power of compound interest works its magic on index funds too. Your earnings can reinvest automatically, snowballing into a tidy sum over the long haul. So, are you ready to let these financial superheroes take your $1,000 and turn it into something truly marvelous? Strap in, because we're not done yet. There's more wealth-building wisdom on the horizon, and we're about to dive right in. And guess what? We're not slowing down, because the next stop on our adventure is all about venturing into the world of real estate without breaking a sweat. After riding the waves of potential with index funds, it's time to dip our toes into real estate crowdfunding. Think of this as your ticket to becoming a part owner of real estate ventures without needing to cough up a massive down payment or manage properties yourself. Let's consider the following scenario. You pool your funds with other investors to collectively invest in real estate projects. It could be anything from residential properties to commercial spaces. Your $1,000, which might seem modest for traditional real estate deals, becomes a part of something much larger, opening up a world of investment opportunities that were once reserved for the big players. The beauty of real estate crowdfunding is that it's accessible and flexible. You don't need to be a real estate mogul to get in on the action. Plus, you get to enjoy the benefits of rental income and potential property appreciation, all without having to deal with the nitty-gritty details of property management. Now, let's take a look at how to crush high-interest debt. As we've seen, our $1,000 has been through quite the adventure. We've explored different strategies to make it grow, to multiply it. But there's one enemy of financial growth that we can't ignore: debt with sky-high interest rates. Paying off high-interest debt should be a top priority when looking to maximize returns on $1,000. Credit cards, for example, often carry interest rates of 18% or more. If you have $1,000 credit card debt at 18% and put your extra $1,000 towards paying that down, it's effectively an 18% return on your money. That's because every dollar you save in interest payments is a dollar that stays in your pocket. Without that debt, you could then invest that money or use it for other productive purposes. Let's run through an example. Say you have $2,000 in credit card debt at 18% interest. That means you pay $360 per year in interest charges, $2,000 times 0.18. If you take your extra $1,000 and pay off half that debt, you now owe only $1,000 at 18%. Your new annual interest cost is $180 instead of $360. By paying off that $1,000 chunk, you've earned 18% on it by avoiding those interest payments. It's like you invested the $1,000 at an 18% return. The key is to prioritize high-cost debts first. Make a list of interest rates on your loans and pay as much as possible towards the most expensive ones. This will maximize the guaranteed return you receive by avoiding interest payments. Eliminating high-interest debt frees up cash flow and gives you more money to keep working towards your financial goals. It's one of the smartest things you can do with an extra $1,000. Now, let us share with you the golden nugget that will take your money to new heights. When it comes to investing, the key is consistency and taking a long-term approach. Rather than trying to time the market, invest regularly over time, regardless of ups and downs. This strategy, known as dollar cost averaging, can help smooth out volatility and lower your average cost per share. Dollar cost averaging simply means investing the same fixed dollar amount on a regular schedule, like $100 from each paycheck. When share prices are high, your fixed amount will purchase fewer shares. When prices are low, the same dollar amount will buy more shares.
You can't make progress in your financial life going around borrowing money at 18 or 20%.
Over time, by investing through ups and downs, your average cost per share will likely be lower than the average market price. Basically, you'll buy fewer shares at peaks and more shares at troughs. This helps reduce risk from investing your entire lump sum at the wrong time. For example, say you invested $100 monthly and the market had 3 years at $10 per share, 2 years at $20 per share, and 3 years at $30 per share. Your average cost would be $18 per share versus the total average of $20. The power comes from consistency and discipline, investing your set amount every month or pay period, no matter what the headlines say. Over long periods, this regular investment approach can really begin to compound. So, you've got the tools from Warren Buffett's top 5 strategies. Turning $1,000 into $10,000 is within reach. Act on these. Witness the transformation. For more insights, subscribe and hit that bell. Until next time.